So Cathie Wood and ARK Invest have been all the rage in 2020. Their flagship fund, the ARK Innovation ETF, ticker symbol ARKK, was up over 150% in 2020 alone. But since then, the fund has really underwhelmed investors. But being pretty much flat on 2021 is now the time to bail out of these ARK ETFs because they're gonna slowly die down to the pits of hell. Or are they just getting started and they're gonna rocket to the upside? Honestly, in the short term, I think both possibilities, both up and down, are very possible. But unless something drastically changes within ARK ETFs, I think that it is inevitable that these ETFs will slowly fall all the way down to the pits of hell. And with the reasoning that I'm going to discuss in this video, when the right market sets up, not if, but when the right market sets up, I will short some of these ARK Invest ETFs. Now, I can already hear the keyboard warriors kicking off in the comments who are big fanboys of Cathie Wood and ARK. But hear me out. I'm a big fan of Cathie and I'm a big fan of innovation. I just think right now, with what's going on, these funds are one of the biggest risks in the stock market. So put down your keyboards. You don't need to type, you don't understand growth, or even dilution is actually a good thing. And yes, somebody genuinely had an argument with me trying to convince me that dilution on a stock is a good thing for the holders of said stock. Absolutely crazy. But hear me out, I do like Wood, and I should not say that out loud. But I do like Cathie Wood and her strategy. I get the whole innovation play and disruptive tech, or so she calls it. I completely understand. But again, when the right market does set up, this will be one of the easiest shorts out there. But with their ETFs at the current standings, I do feel a lot of new investors are unwittingly buying into ARK ETFs without understanding the risks. I think that ETFs over the last sort of 5-10 years, really since YouTube started, a lot of people have been pushing just buy ETFs regularly, keep buying them, lower your risk, it diversifies inside itself, which is true, but I feel a lot of people sort of discount the fact that some ETFs are better than others and some are higher risk. And trust me, ARK Innovation, like I'm going to show you, is definitely higher risk than if you just bought some simple blue chip stocks. So let's crack on and see my findings on why I think that this will be an easy short at some point in the future. But first, let's all join the like button club. All you have to do to gain membership is make sure that like button is turned blue and follow the simple rules. Rule number 1, we do not talk about the like button club. Rule number 2 is we do not talk about the like button club. But to gain access, you need to make sure that like button is turned blue. Now, swiftly moving on, let's talk about some of my findings. Now, we're only going to be talking about the flagship fund that is ARK Innovation, ticker symbol ARKK, which is for sure their biggest ETF. And we're going to mainly look at their top 10 holdings because if we looked at everything, firstly, this video would be about 6 hours long, but their top 10 holdings do paint a good picture because it's pretty much 50% of the total fund itself. But putting these top 10 holdings and looking at some very basic criteria, some things do become apparent, and it sort of made a perfect, clear picture why Michael Burry, one of the greatest short sellers ever to have existed, is currently short via options on this fund. Why, you ask? I'm going to show you. If we look at ARK Innovation's top holding, which is obviously going to be Tesla. Now, they are invested in Tesla just over 10% into this one company, which again should raise alarm bells if you're looking for a low risk ETF and 10% of their holdings is in just one company, regardless of who that company is. But whichever way you paint it, it's obvious why ARK Invest is so bullish on Tesla. This stock alone really made Cathie Wood famous because she's been investing into it for a long time. My big problem with this individually is she's continuously buying as the price gets higher, which of course is ruining her average. Now, I'm not going to get into Tesla in itself because if you're a subscriber of the channel, and if you're not, you should, but if you are a subscriber, you can go and see my previous Tesla videos on why Tesla is, in theory, overvalued at its current price, because a lot of their future growth is priced into their current market cap. But that all aside, looking at their top 10 holdings, if you put a gun to my head and said I have to buy one of them, Tesla's probably one of the ones I'd look at. And that should tell you how bad these top 10 holdings are, in my opinion. Now, the reason is dead simple. If we look over a 5-year period, Tesla is diluting a lot less than the majority of these 10 holdings. Dilution is one of the most important factors when I look at buying any stock, especially if I'm looking to buy a stock at value. Over the last 5 years, Tesla has added about 17.5% to its float, which actually means that people who bought Tesla 5 years ago now own less of the company in terms of a percentage. But trust me, it's definitely not that bad in terms of dilution as we go through this list. If we also look at Tesla over the last 12 months, we can see that they're pretty much flat. They're down about 1%. They are profitable though, but if we look at their PE ratio, the price to earnings ratio, which is one of the very basic things that people are overlooking right now, their PE ratio is 350 or thereabouts at the recording of this video. Now, what is a PE ratio? Well, PE ratio stands for price to earnings, and it is a very easy way of determining if a company is good value. Now, it is not an exact science, but historically, it has been proven to be a good indicator or a first indicator of if a company is good value. Now, historically speaking, the S&P 500 is around about 20 PE per year. So Tesla is 350. If we look at other good companies, you want it as close to 1 as possible because that would mean, in theory, the company is an absolute bargain. Tesla is 350. So put that into context. In theory, on the PE alone, Tesla is really overpriced. And I think this is one of the key reasons why Michael Burry is so bearish when it comes to ARK Innovation, because a lot of their PE ratios in all of their stocks are pretty damn horrific. Now, their second holding, Teladoc or TDOC as their ticker symbol is known, is a decent size holding as well, coming in at 5.52%. Their year-to-date performance is down 29%. And of course, this company is not profitable and actually looks quite far away from being profitable. And if we also look at over the last 5 years, this is pretty horrific in terms of dilution. 5 years ago, they had 54 million shares on the market, and right now they have 156 million. Absolutely horrific in terms of dilution. They have added an extra 188% to their float. That's not adding 88, that's adding an extra 188% to their float. Nearly 3 times as many shares. But because they're not profitable, we can't look at a PE ratio because that's what you need to have a PE. Again, this company, in my opinion, is not a bargain. It's definitely far from it. It might do well in the future, it really might, but I'm staying away from this and I wouldn't touch it with your account, never mind mine. Looking down at stock number 3, we have Roku, which share price has done decent over the last 12 months and is up around about 11%. And they are indeed profitable. But if we look at their 5-year dilution, they are still diluting. They had 94 million shares 5 years ago, and now they have 132 million, which means they have diluted an extra 40% from where they were 5 years ago. But their PE ratio is a little bit better than Tesla at 207. Still, 10 times the average of the SPY. Mental. Now, next up, we have a recent IPO, which is Coinbase, the crypto exchange. Again, pretty damn horrific. And looking at it, we can see that there is 4.84% in there. It's down 30% since its IPO. It is profitable though, but because it's a recent IPO, we can't look at their 5-year dilution. Therefore, we don't have that number. But I can confirm they have been diluting since they IPO'd. And if we look at their PE ratio, this is actually the best out of the top 10 at 19. So if you go on the PE ratio alone, Coinbase could be somewhere around fair value if you take out the complete crypto risk that is coming, where regulation is looking at coming in terms of China, US, etc. And if Coinbase does get regulated, that's a high risk in my opinion. So this again is a big no-no. Now, rather than go down the full list of these, I'm going to put it on screen now so you can have a look at what I am talking about. Their PE ratios are huge. Their dilution is pretty damn horrific. A lot of the companies, 40% of their top 10 holdings, 4 out of 10, is not even profitable, which means, yes, I know it is a growth ETF looking at companies that will become profitable in the future, but this is the exact point. New investors do not understand that they are getting into higher risk investments. 50% of this ETF is allocated in just 10 stocks, and out of them 10, 4 are not profitable. And it gets even worse. If we do the average dilution of 8 of them, because 2 of them are recent IPOs, we can see that the dilution alone in 5 years is up over an extra 53%, which means your pie is getting less and less and less the longer you leave it. So you better pray that these stocks do moon just to try and break even. And the big one, the big PE ratio, if we do the averages, again excluding the 4 that are not profitable because we can't add them, their PE ratio of the other 6 is a horrific 168. That is definitely not a good average PE. And this is what Michael Burry is getting at. If these companies, if the world does crash, these companies are going to get hit the hardest. And that brings me on to my reasoning when, not if, when I will short these ARK Innovation ETFs. Now again, to be triple clear, if you bought these ETFs and held them for 10 years, there is a very high chance that at some point you would be green. But the problem is, you could sit through a hell of a lot of pain to get there, or you might not take profits and then will sit through some hell. I promise you, these ETFs will be hit hard when a market crash comes. And that's the key, when a market crash comes. Whichever way you shape it, we are way overdue a correction, a market crash, or some even say the worst thing since the Great Depression. I think first we're going to see a correction. I think we're going to see it in the next 6 months. I think we might even see it worst case in the next 12 months, but reality, I think probably the first quarter of next year. If that does happen, then we are in a world of shit in terms of the ARK Innovations, because companies that are going to get hit the hardest are companies with low cash flow, companies that are diluting, and companies with high PEs. Hedge funds are going to lower risk, and these are the first type of companies they're going to pull funds from. Companies that don't have good cash flow and don't have good profit revenues. And guess what? That is majority of these companies we've had on screen today. So think about it. Market crash comes. Let's say the SPY falls 10%. These funds could really fall 30% plus. I am not joking. It could be horrific. They may not, people might flock to it, but that is my thoughts and thesis. So when a market crash does come, or there's indicators there of a correction, I'm probably going to do exactly what Michael Burry did. I'm probably not going to short it. I'm definitely not going to use leverage, but I will probably use some options. The reason being is I can short them with options, pay a fee, and if I'm wrong, my risk exposure is a lot less, because the worst thing I can do is lose the fee of actually having these options. Now, I'm not a big advocate of using options. In fairness, I actually really despise them, but I think this is probably the safest way of playing it in case I am wrong with my timing. And I want to be clear, I don't think I'm going to be wrong with shorting them at some point. But in the meantime, I think this is a clever way of lowering your risk. Now, if you want to see when I'm actually going to be shorting this, or when I throw out the options and what options I'm looking at shorting, then if you want to see that, my buys and sells, you can do it via Patreon. Check out the link down in the description. And you can even see exactly what I'm doing on a day-by-day, minute-by-minute basis. But to summarize here, I just want to be very clear. I am not saying these funds cannot go up. I'm saying that there is a possibility that they do continue going up. But when a correction or a market crash comes, I think these ETFs will be hit a hell of a lot harder than other companies like your Apples or even your Amazons or even your oil players. I actually do think these ARK ETFs will be hit a hell of a lot harder than the overall market, thus meaning I can make a decent return. Let me know what your thoughts are. Are you bullish or bearish on Cathie Wood and the ARK Innovation Funds, let's say in a 2-year period? Let me know your thoughts on that down in the comments. It's going to be very interesting to see who's bullish or bearish, because I'm really in the middle on a 2-year period unless that correction happens. Drop the code word down below, which is crash the ARK, down below in the comments as well. That's it from me. Tickle the like button on the way out, and I'll see you in the next one. Take care. Peace.